Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you what is an after-tax 401k plan and explain some of the pros and cons of those types of plans. And there's actually a combination. It's not called an after-tax 401k plan, but you have a couple different accounts that are set up that work very similar to how that Roth 401k plan would work. And, what is the difference between the pre-tax and then after-tax monies, and go over all the different benefits and explanations there. And then essentially what you want to try to get out of every retirement plan, or what we've seen with clients that we deal with on a daily basis, or even prospects that are basically calling into our office, where we see success in those types of plans, and then we see those other individuals that are scared every day, worried that the market's going to go down. So I want to show you a couple of neat techniques to make sure that you could have that peace of mind in retirement and set up a plan proper to what your goal is and what your specific situation is. So to get started off, we have this little bullet point. It says tax-free versus taxable for max income in retirement. One of the large factors regarding an income play, or regarding a type of 401k account, is this is a type of retirement account that's set up while an individual is working for a specific company. So this person would be working for a company, They're taking a percentage of their salary, and they're placing it into a 401k plan that's being offered through their employer. So a 401k plan is offered through private institutions, just like how a public institution might offer a 403b plan. They're very similar in nature, but it's one's deemed a 401k, the other's deemed a 403b. Now, the way that this money grows is each dollar that this person is placing into the plan from their salary. So if we use an easy example of saying, somebody makes 100 grand a year, and they want to go and place 10% of their salary into this 401k plan, well, at the end of that year, for each dollar that they place into that plan, it's known as pre-tax, meaning that for each dollar they're placing in, it's tax deductible. That's how a traditional 401k plan works. So that means $10,000 is going into it, $10,000 is going into it. So at the end of this year, this person is not taxed as if they made 100 grand, but their adjusted gross income is now going to be $90,000. So they're getting that tax deduction now, they're getting that tax deferred growth now, but after, right when they hit retirement, all of that money that's accrued is now going to be fully taxable. So that's why when someone, and this is known, a regular traditional 401k plan is known as a pre-tax plan, as opposed to a Roth 401k, which is known as an after-tax plan. And what it says is these dollars are going to be deemed for retirement, meaning after age 59 and a half. So after this bucket is essentially getting larger and larger and larger, when they have to wait till 59 and a half to take their first distributions. So the major difference is going to be the taxation point of it, meaning, with a after-tax 401k plan, a Roth IRA, a Roth 401k plan, it's going to be tax-free money is going to come out of that account. So and one of the other things, to take a step back, rather than with a 401k plan that you're getting that tax deduction now, it's growing tax deferred and then it's going to be fully taxable. The Roth 401k plan says you're not receiving the tax deduction, meaning you're paying your taxes now. So this person that's throwing in 10 grand a year, after they made 100 grand, it's not as if they only made 90 grand that year off their adjusted gross income. It's still showing that they made 100 grand. But those dollars are now being set up, it's growing tax-free, and then when it comes out, that money is going to be 100% tax-free. So it's very, very powerful, especially in today's age where, there's a huge question mark saying what's happening with tax brackets. We understand that, or tax rates. We understand that, the government has accrued this large deficit, and all indicators are leading that, monies or tax rates and tax brackets are going to be going up for income. So while an individual is placing dollars aside in their retirement accounts, they were saying, oh, I'm getting a tax deduction now, my income is going to be less in retirement, so it should be a lot cheaper, and everything worked out perfectly. Well, now if we're at all-time low tax brackets, and tax brackets are going to be increasing, or indicators are showing that they're going to be increasing, well, then you're basically shooting yourself in the foot, because you were deferring that growth for that longer duration of time, and then right when you need that money the most, in retirement, you're going to be fully taxed on that money. So that brings me to my next column, which says market, income, and inflation. Now, the happiest individuals that we deal with on a daily basis, whether they're pre-retirees or they just started their retirement, they all have these factors covered, making sure that they have that peace of mind that they could live their retirement years with confidence, that they could constantly live. They could, go on vacations. They could travel. They could go visit their grandchildren. They could go fishing. They could play golf every day, whatever the case may be, is they have to make sure that these plans have three separate segments covered. And this is where a lot of the traditional 401k plans and even the after-tax 401k plans come into a big conflict. And the reason being is because they have a certain risk known as reverse dollar cost averaging. You might have heard me speak about this before. But the major risk at the very end that I don't necessarily mention is the inflation risk that is also incorporated with reverse dollar cost averaging. So what do I mean by that? If you have an account, it doesn't matter how many dollars you're placing aside out of your salary. You could be throwing $10,000 a year into this type of plan for the next 10 years. You have 100 grand sitting in this account, and okay, if the mutual funds that are tied with that account are doing well, well, then this $100,000 could be growing, much higher. The downside happens when it comes time to retire. You're trying to plan for your retirement because now you understand that you're going to try to take income from these types of accounts. Well, if you pull income from this account, first off, you have to make sure that you're pulling out the correct income that's going to suffice what your expenses are each and every year in retirement. So you're going to have this big guessing game of saying, okay, maybe I'll pull out 4% this year or 5% the next year. And if the market has a correction that year, well, then that account could be reduced by 20, 30, 40, 50% in a given year. So somebody that walked into the year with $1 million in their 401k plans thinking, okay, this is amazing. I'm going to, the market has been so good to me for all these 10, 20, 25 years, whatever the case may be. And then the market had a shift. And this was very prevalent, very key in 2008, and it really hindered the mindset of seniors and retirees of having them freak out. And now we have clients of millions of dollars, and they're still nervous because of the fact that they didn't have that income plan set up properly. So you have to incorporate that first off with 401k accounts. Typically, if it's tied to a mutual fund, you have those 401k related fees that your account has to beat out. You have mutual fund related fees. You have an advisor fee. If an advisor is monitoring you on those accounts, they're going to charge you a wrap fee. It doesn't matter whether that advisor is telling you the correct information or not. That fee is always going to be coming out. The fourth negative, I guess you could say, is downward market loss, meaning if the market has a shift, well, then your account's going to have a shift with it. It's going to mess up your entire plan for retirement and how to retire successfully. If you try pulling income from this account, well, then that's a fifth negative. If you go and let's say we're incorporating inflation, a lot of people, they realize that they have fixed expenses in retirement, but they don't realize that a lot of those expenses are now set up for inflationary risk, meaning that each year the cost of goods and services can increase by 3%. On average, it's showed to increase between 3 and 4% per year. So what's exactly your plan? Are you going to try to pull out money from an account that could potentially go down, that's getting hit with fees, it's getting hit with advisor fees, that has that potential downward market loss, you're pulling income from it, and now you're tacking on another 3% of a negative because of inflation risk? These are a spiral. This is a vortex of bad things that occur, and that's why the numbers are so large that individuals cannot properly retire, because they're constantly playing this guessing game while you have advisors out there that they try to talk about the growth and the return and all of that, all that fun stuff. It's very good to always think about the amazing growth, but the reality is if the market crashes, your retirement is gone and you don't have those years to get that back. So, which then leads me into my third point, which is income, cash reserves, inflation protection. And we set up plans in our office that work very similar to how that Roth 401k plan works, except for when it comes time to trigger income, you're able to receive that money income tax free. It's able to grow within those accounts completely tax-free. When there's a market correction, you're gaining 0%. You have a 0% floor. When the market goes up, you're going to participate in those gains as well. And they're specifically designed retirement insurance contracts meant to eliminate the market risk, the income risk, and the inflation risk. So as each and every year that you're taking money out of this plan, that account's going to be growing because we're eliminating that downward market losses. We're eliminating those mutual fund related fees, those advisor fees with that type of account, and you're able to receive max income at a tax-free manner. So with the three main components with any sort of retirement plan or income plan, when individuals do it successfully, they want to make sure that they're at least covering enough income for what their expenses will be in retirement. We want to make sure that a portion of it is sufficing their fixed expenses. The other portion is stepping up for their inflationary expenses. The cost of goods and services, that aspect is covered. Whatever we could do to suffice that, we want to place as little as possible, but as much as necessary into these types of plans to make sure that we can now have the maximized cash reserves. If we go and we suffice the smallest amount of dollars to create the greatest result, making sure that all three of these are covered, well, you could go and have those emergency monies, throw that into cash in case something was to ever happen. You have a bucket to pull from. But everything in addition to these three aspects are now going to be your fund money. This is going to be the money that you can invest into the market, that you could leave into the market, that if the market does well, excellent, I'm going to go on vacation this year. I'm going to get a new golf club, whatever the case may be. If the market goes down, well, that was my fund money that went down. It wasn't my necessary money that went down. So that's the very important aspects that we have to make sure is set up with each and every plan so that you could have that peace of mind, you could have that confidence in retirement. If you found value in this video, feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service. We have specialists standing by. Give us a call. Say that you saw, an advertisement, you saw this video online, and you wanted to speak with a specialist. And somebody will speak with you, and they'll go over what your current situation is, what potentially your goals might be, and how to suffice all these different requirements properly, making sure that you're placing the smallest amount of dollars in there with the most amount of benefit. And we're an independent agency that allows us to go through all multiple strategies, contracts, carriers, proprietary to your situation, and we utilize something known as a retire sharp planning system that gives us access to all these different options for your benefit. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of this methodical process. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos.